that was the first slot, so to say, on the way how the current money system works, what is going wrong. And I think this is the basis for the continuing day, which is very important, of course, even though it might not be completely related to the rest of the conference. But let's stick to the current money system. And so we've learned a lot about the deficiencies of the models that are used by the central banks currently. And we also learned, for example, about your different model. And the question that arose at the guests, but also, of course, which is my question, is what is the reception of that model in central banks and other institutions? Is it being used? Is also the creation of money by commercial banks really understood, or are we still in the infancy of that? Maybe you can, everybody that likes to respond to that can respond.
Yeah. So I've presented this work more at central banks than in academia, but also in academia. At central banks, I typically get almost complete understanding. The exception is recently trained PhDs. Because recently, the exception at central banks is recently trained PhDs.
Oh, I see. Yeah.
So they don't accept it.
Yeah, and I have, and then in academia and among some of, part of modeling teams at central banks, I've had amazing experiences on one occasion. I'm not going to mention name, obviously, but, the Bundesbank, the Bank of England thing and also the Bundesbank thing had just come out, and this researcher was sitting there and he was shaking his head. He said, I can't believe they're writing this. They don't know what they're talking about. And I looked at him and I can't believe you're saying this. These are people who have decades of experience with money in a central bank. You don't have the first idea. But this is the kind of thing that that was extreme. But in academia, typically, this idea is harder to sell. A lot of people have careers invested in this, and that's obviously important. And you also get arguments that you need to spend a little more time on diffusing. For example, the argument that, well, maybe the banks create money for one agent who came into the bank, so the loan and the deposit is in the name of the same agent. But then that agent is obviously going to spend that money, and so then ex post, somebody else holds the deposit, and therefore it's still the same as in the model with savers and borrowers. That, however, is complete nonsense because it is still not thinking in terms of money. Because what has happened here is that it isn't the case that once that other agent gets the deposit, he has to be a saver. Because he wasn't actually at all involved in this transaction when it first happened. He never had an intention to save. And then suddenly the bank creates money for somebody else. That somebody else pays this person, and now he suddenly decides to be a saver. Why? Because he isn't a saver. All he intends to do is to use this money to get paid for what he produced. And then afterwards, he's going to spend it on his workers, on his inputs, etc. Money circulates throughout the economy all the time, and that's the essence of the beast. And therefore, to say that this guy is a saver, no, what he is, he's a holder of money. He has various motives to hold money, transactions motives. As you said, 98% of those transactions motives may be related to financial rather than goods markets, but no matter, right? He has an incentive to hold money, not an incentive to save. And this is actually important. When you think of the incentive to save, this is the incentive to smooth your consumption, to smooth your labor effort. If you think of the incentive to hold money and the corresponding liabilities, this is an asset demand motive. This is my incentive to hold gross stocks rather than net physical flows of gross financial stocks of assets and liabilities. That's a portfolio motive. And that allows, because it's gross stocks, that allows you to expand or contract your balance sheet positions by great amounts in days, if you want to. If it's about savings, if it's about smoothing consumption and labor effort, the incentive behind that is a completely different one. And so sorry, that's a long story, but I think it's important.
May I add something that I thought, Michael, you would do, because you
are the right one doing it. He asked you about the models. The thing is that the models that are generally used by finance ministers, central bankers, are still the ones where the bank system is intermediaries. And that's the one when our finance minister here is calculating the effects on the economy, those models does not include the financial system. And what Michael we expected you to say is that we are
so much I could say.
We are a number of in the network of universities, including Michael and Bank of England, that are trying to get funding for developing the existing models with the financial system. And we have had great difficulties in getting funding, also from a fund like Riksbankens Jubileumsfond, because the evaluators of these proposals are generally orthodox economists. They don't want to hear about the banks not being intermediaries, and probably are afraid that if central bankers and finance ministers understand how the financial system affects the economy, aggregate demand and other things, they will start, this is a system that we have to regulate. And that's not what they want to hear. This is a bit of a, I'm not sure that's the whole motive, but you get suspicious after a while when you see that this, I mean, how on earth can we live with a situation where we are supporting knowingly finance ministers and central banks, heads of central banks, with models that are misleading, completely misleading.
Just a really quick thing to add. In Frankfurt, we've had a conference in November. Many of you were also there, and there was the head of the monetary policy division of the ECB. And somebody from the audience asked her directly, is the ECB actually implementing these models now? And the answer, to my mind, was very interesting, because she actually said, yeah, the ECB cannot include all theories.
So you leave out the theory they don't like.
The bottom line. Is it still a theory?
That was a very political response.
Yeah. I mean, what I've seen is what we are saying is a heresy. And Michael is saying the heresy directly to neoclassical economists because they come to his talks, they don't come to mine. And what they're trying to do is to find ways of avoiding the implication of this. So I've seen 4 papers in the literature, neoclassical literature, about loanable funds versus endogenous money. And 2 of them conclude that it matters, and 2 of them conclude that it doesn't matter. Now, neoclassical economists are going to quote the last 2, not the first 2. They use what they call overlapping generations models, which is kind of the clumsiest garbage neoclassicals produce, far clumsier than DSGE, and that's saying something. Sorry, Michael, but you know my opinion. And so they'll just say, oh, it doesn't matter, and we can continue working with loanable funds models. Now, one of these papers, and this is seriously from its abstract, said that loanable funds only matters in the case, so endogenous money only matters in the case of bank defaults. Therefore, we can use loanable funds assuming bank defaults don't exist. 10 years after the financial crisis.
Yeah, I would wanted to say one more thing. When it comes to policymakers, you get two problems. One is you often talk to them, and not even among research. You sometimes get people that say, "We understand this," and then you start talking about a particular economic problem where this matters, and they give you their reasoning, and suddenly you realize, no, you don't.
No, they don't. Yeah.
You know, they make loanable funds arguments because they are so marinated in this idea that it's impossible to escape from.
I'll use that phrase in future.
Okay?
That's good.
And then even the ones, then there are the ones who really do understand it, thoroughly understand it, but they don't have the tools to work with because they're not being offered to them. Right? That's another problem.
Given that we now talked about the problems of the description of the current money system, the idea now, I think, is to look at how this current money system can be controlled, and how or which instruments exist, and if there are maybe additional instruments we need to actually steer the current money system. So maybe a question to you at the end. Do you believe that the current money system actually works quite well, that the instruments that the central banks are using are working? And if there's maybe something, we're discussing CBDC here, that could add value to the number of instruments they're using.
Thank you, and thank you also for the opportunity to be here. On a personal note, I think it's very important to expose oneself to alternative ideas and theories and so forth. But I have to confess that I'm not entirely convinced that we are talking about universal problems here. And perhaps let me just provide you with a Norwegian perspective. We have one of the oldest central banks in the world. It was founded in 1816, and it was the only bank in Norway for quite some time. It issued coins and notes, of course, but in the 19th century we experienced a financial revolution, in the sense that we had savings banks popping up all over the country. We had private banks, and ever since 1855, coins and notes from the state issued by the central bank has comprised a decreasing part of the broad money in Norway, and today cash accounts for just 2 or 3%. The point I'm trying to make, though, is that we have a special banking structure that more or less resembles, I think, something that you could define as optimal. Lots of small banks all over the country. They tend to be very, very conservative and boring. Lots of equity also. And the thing is that these banks create broad money, yes, but they do it very, very close to their communities in a decentralized manner. And I'm not entirely sure that that system is posing the kinds of problems that we have been talking about so far today.
So you say money creation locally for the real economy is not really the problem.
Exactly. And if you were to change this and give the state a more important role again, that would entail a centralization of power. I'm not entirely sure that that would be optimal in all states. But what I do think is that it's very important to look to Sweden, because what is happening here in relation to the E-krona project is that the central bank has issued a recommendation to the parliament. The parliament in Sweden is going to debate that recommendation on Tuesday, I think. And I think it's very important that if you're going to have a massive or vast monetary reform, that has to be an issue for parliament, politicians, and not for the central banks. Yeah. So I think Sweden here is leading the way. The central bank in Norway also exploring the CBDC option, but in-house it's not a political issue. I think it's very important and interesting that that is changing here in Sweden, actually. Maybe
quickly come back to the money creation for the real economy, decentralized money creation. So I would say that most of the panelists also here would definitely agree on that is not really a big problem. However, I believe that in most of the Western economies, this is not the case anymore. So we've heard that most of the money is not spent on real economic transactions. So there's like money creation for transactions in the financial sector, which only inflates prices. And I think that is a big problem. And so is there a way with current regulation or other types of regulation how we could bring that back into the real economy? So I'm thinking about TLTROs. That's, to my mind, the only instrument that is used by central banks to really make the banks lend to the real economy. There's not much else to my mind. So interest rates are cutting down, then they hope that the banks create more money for the real economy, which is not happening. Where could be a solution? Could window guidance be a solution to where credits are limited to certain sectors, or what can we do?
Can I add to that? Because this is a debate going on among those who are skeptical to renationalization of money. And there are many proposals that would support this development. One is that actually when we have a default, we should no longer go along the route of merging banks. We should split them up. Especially take out the investment banks out of the bank that has defaulted, and make them local and smaller. So this is one way. Another way is actually using capital requirements to say that the larger and more exposed the bank is that way, the higher capital requirements, so that actually the smaller banks that are less risky benefit from having lower capital requirements, which will encourage the creation again of small banks. So there are many ways you can do it.
So taking smaller banks into consideration with the regulatory apparatus that exists, because I also believe that, I mean, we still have the problem of too big to fail, but we also have a problem of too small to comply, so to say, because small banks, they cannot really provide the resources to make sure they fulfill all the regulatory requirements. So is there a drive into more centralization, into more bigger banks that are not really interested to create money for the real economy, maybe, yeah? And which leads to certain problems such as debt overhangs, asset price inflation we are currently facing, and also a downward pressure on interest rates that we are facing now basically all over Western economies.
Yeah, agree.
Can I just add
Sure,
one perspective? I think one of the problems is that what kind of banking structure you have in a country has to do with pure luck and path dependency. And if you end up with a banking structure characterized by large and few banks, a lot of systemic problems in that regard, there may be a case for some policy in terms of trying to alter the banking structure. And that may apply to Sweden also, of course. But I think that has been some part of the debate in the UK, with Corbyn also thinking about new banks in order to just alter the banking structure.
I can agree that I prefer the structure of small banks and so on, but I'm not going to agree at the aggregate level. When I look at the data, your situation is just as extreme as Sweden's. Looking at the level of credit creation in Norway after the global financial crisis, you hit 35% of GDP, larger than America by a factor of 2.5. You're currently having plunging credit. If I look at the correlation of credit and unemployment, it's minus 0.62, which is barely different to what I got for Sweden. And when I look at the level of household prices and household debt using the same scale I use for Sweden, Norway's off the scale. Okay, so I think this is all the BI, no, but it's an important part of the picture.
Yeah.
Okay, I don't want to see this and say, okay, it's a part of the picture, therefore ignore it, which is common, I'm afraid, amongst regulators who don't want to be confronted by these issues. So I think you have macroeconomic issues about level of credit in your country which you can't ignore by saying we have a different structure.
Can I say one more thing that came up? I think you said it, is that nationalizing money would increase centralized control. I think there is a misconception here.
Good point.
Because all we're talking about is nationalizing money, not nationalizing credit, right? And so the quantity, and I'm going to come back to that. Let's for the time being say we're controlling the quantity of money. The allocation of that money would be completely up to the private sector. And if you do that, you can deregulate a lot of the regulations that you have now imposed. And therefore, you actually have less centralized control because you don't need that control anymore. Secondly, you don't even need to control the quantity of the money that you issue under a system like that. You could, it's a decision to make, but you could issue it under an interest rate rule. An interest rate on money, which is different from the risk-free rate that we're controlling these days, in which case the banking system could obtain this money at a certain interest rate and blend it out. So there's not even this notion that, okay, we have only centralized control of money, but it's pretty rigid because we're just saying, here's your pot of money, deal with it. That's not even necessarily a design feature of the system. So centralized control is very misleading. It's not that centralized, not that much control.
Maybe a very quick and last question, given the current instruments that central banks are using, and maybe also looking forward to the discussions we're going to have this day. Is there room or is there the need of another monetary policy instrument that could be facilitated by CBDC? What do you guys think?
My
monetary policy instrument.
Yeah, I would use the CBDC to neutralise the level of private debt we've accumulated, effectively to facilitate a modern debt jubilee. Because we've got far too much private debt's been accumulated by allowing this to happen. We have to get rid of it, and I'd make that the mechanism by which we did it, distribute central bank created money to cancel or to offset the debt that both corporations and individuals have, and use that to also to re-democratise the ownership of capitalism, because one thing that's come out of this huge bubble is an incredible concentration in wealth, and central bank policy, quantitative easing, has dramatically improved the wealth of the rich, because those who own shares have seen their share prices increase. Those who don't, haven't. And that inequality could be reversed by a sensible program of people's quantitative easing.
We haven't talked so much about it, but actually the sovereign debt is now on the same level as they were at the end of the Second World War. And this is a major issue for many countries. And the reason why many countries have these debt levels is that they had to save their banks at the latest crisis. But we have actually, I have been in contact with his old employer, IMF, about this, because we have developed some ideas about making a general issue money to, in a general way, reduce the debt level in states. It has to be done in the same level, basically, in the same principle all around the world, because otherwise you will have a lot of issues. And it must be clear that it's done. This is a one-time thing, because if you accept it as an instrument, then it would be very dangerous. But it ought to be possible if you wanted to, because if the public is in a better shape, the public in a general way, then we would not be so dependent on debt-driven growth. And we also would create the money that we need, actually, to make the investments in sustainable development that we also need strongly. But that's a long story. Yeah.
Do you have something to add to that, or?
Well, it's something that I'm going to say in my talk.
I can send that to you.
Okay.
Very good.
Okay. Do you want to add?
Yeah, just two comments. I stand corrected to Michael, and I think this split between the quantity and the credit allocation was part of this Swiss proposal that was put forward also last year. All right. Yeah. Now talking about the Norwegian debt level, I think what we are also observing there, in terms of that being just part of the picture, is some kind of Ricardian equivalence, in the sense that state saving is so intense, and that has also been proposed as one explanation why private debt is at such higher.
No, I'm not going to swallow
high level
equivalence for breakfast, believe me.
Okay.
All right. Then I would say we cut it off here. Thank you for your questions. I couldn't incorporate all, but the good thing is these questions are going to be saved, and we will publish them afterwards, and maybe also our speakers find a little bit of time to answer them. That is possible. Thank you very much, and we're going to continue after the coffee break.